So Tom Lee was just on CNBC and he dropped a lot of bombshells. And it's important information you definitely need to have because what we've seen over the past week is not really that common. We've seen the S&P 500 drop more than 4% on Monday, a complete mayhem, and somehow close the week on Friday on the positive with 0.2%. Now, that doesn't happen often. In the entire history of the S&P 500, that only happened 13 times. So, CNBC calls up Tom Lee to put on his cape and come on and explain exactly what just happened and what he thinks is coming up next, because so far his predictions, whether you like him, you hate him, you like his hair, you hate his hair, his prediction so far has been spot on for the past 18 months. So Tom Lee came on CNBC, and the bottom line here, because I always give you the bottom line first, I don't hold you hostage. The bottom line is very simple. Tom Lee basically says the pain is behind us, the selling pressure is over, the rebound can be trusted, and the worst is behind us. Now, don't click nothing, don't smash nothing, don't buy nothing. Just sit back, relax, watch the full clip of Tom Lee, and then we're going to talk about it and actually distill some important notes from what he said into the strategy going forward for this week, for this month, and by the end of the year. Watch the clip, and then let's talk about it later. Check it out.
That tells us the worst of the panic is behind us. I don't think it means we won't have ripple effects. There's still some nervousness around Iran and how much of this yen carry trade has to unwind, but I think the worst of the selling pressure is behind us. There's a lot of financial institutions that actually implemented this trade, but if it unwinds in an orderly way, it's not disruptive.
So Tom Lee basically says one simple thing here. He says, look, guys, I do trust this bounce, and I think it's going to be positive, but it doesn't mean that we're over with the red days. We might have a few more scares, we might have a lot of volatility, and we may have more red days. It's not just going to go away, and we're going to ride a green wave all the way to December 31st. It's not going to happen. Besides, we don't really know what else is going to scare investors, and we don't know what the Japan carry trade still has in store for us. It's not fully unwound. Even the most sophisticated investors don't really know exactly how much more time is needed for this. So it's definitely going to be a volatile time. But overall, he says that the worst is over. Now, he did mention the fact that better than expected jobs numbers are really important here. That's what we saw on Thursday, because it means that the whole fear festival we've seen about unemployment is a little bit out of control.
Well, I think investors, when it comes to the growth scare side, have something they can check every week, which is weekly jobless claims, because that's what was a positive surprise on Thursday. The fact that markets reacted so positively Thursday to that jobless claims number puts me in the camp that that's one of the big drivers, because we had a better than expected claims number and then the market popped. I think the growth scare is what's on investors' minds, and next Thursday they'll get another weekly claims number, and if that's also equally improving or stable, I think it's going to give people a lot more conviction.
The markets have overreacted like they tend to do, especially in 2024, with taking bits and pieces of data and basically inferring a full-on risk of recession. And now the jobs numbers that just came out basically said, well, look, it's not that certain. The risk of a recession is not as intensive as we thought a week ago, and the market is starting to adjust and correct. And that's good for stocks. Basically, what he says here is like, look, guys, we know that what happened on Monday was a complete stampede. People freaked out and they caused the market to crash. But if it's done in an orderly fashion, whatever the remainder is of the Japan carry trade, and if it's done slowly, it can be done without crashing the market. It can be unwound very, very orderly, and it's not going to be very tumultuous. All we need is for people to relax and do it orderly and not stampede for the exits. And so far, in the second half of the week, it seems to be happening. So it's not completely out of the realm of possibility that Tom Lee is right on this one as well, that the whole risk of the Japan carry trade is basically over, even if it's not fully unwound yet. The other thing he said here, which is very important, that he actually agrees with Jeremy Siegel that a 0.75 cut is what the market needs right now.
I think both comments from both Ron and Jeremy Siegel are actually valid, but to me, what it speaks of is I think the markets and I think economists are no longer willing to deal with data dependence. I think they want a Fed that's more forward-looking, because that makes them comfortable the Fed could respond if conditions deteriorate. I think that's the kind of language I'd like to see disappear, is we're data dependent, so that by necessity they're going to be very late.
What I think he talks about here is the fact that the Fed is now under a lot of pressure from some influential people like Jeremy Siegel, like Elon Musk, and they won't have a choice but increasing from 0.25 to 0.5%. And that's actually pretty good for the market as well, at least if you're actually looking long term. We've talked about the short term effects of rate cuts. It's all going to depend on the state of the economy. And we've covered this in previous videos. I'm not going to repeat myself, but basically, the bottom line is that the stock market will only react positively to rate cuts if the underlying conditions of the economy are good enough. A rate cut in a bad economy is not going to help anybody. Now, let's talk about what he said here and let's take away some strategies out of here. Number one, I'm going to say it straight up right here. Look, there's always going to be reasons to sell. And I think Tom Lee kind of alluded to this, but not fully went in hard on this. But let me kind of reiterate this point. There's always going to be reasons to sell. There's always going to be wars. There's always going to be chaos. There's always going to be economic crises and risks and indicators and experts who are selling and telling you that the world is ending. There's always reasons to sell. But if you look at the S&P 500 over the past 50 years, it has always gone up, jumping in and out of the market because of fear of geopolitics, of economic collapses, and all sorts of things never paid out. The people who stayed in the market benefited. The people who tried to time it for the most part got screwed because the market still kept going up for the past 50 years, even with all this craziness we've seen. Even in the past 10 years, think about what we went through just in the past 10 years. Hell, the past 5 years, COVID, a war between Russia and Ukraine, the Middle East is completely on fire, inflation out of control, crazy money policies. We've seen the geopolitics basically all over the world going crazy. This whole thing basically did nothing for the market to stay on track. It had a bad year, then it had a couple of good years. It may have another good year, or whatever happens, happens. But at the end of the day, at whatever point you take the S&P 500 and you stretch it out for 10 years, it's going to give you that 10% return. It's not going to change no matter how many reasons you have to sell. And I think Tom Lee is kind of alluding to this. Guys, have a little bit of a long-term perspective here. The other thing I like right now in this market, and I agree with Tom Lee, is that we are in extreme fear, or fear, depends on which day you're checking, but the fear and greed index, which I think everybody should be checking on a daily, basically is now between extreme fear and fear. Historically speaking, when the market is fearful, it's not a bad time to buy equities. Also, the markets usually don't crash when people are anxious and tense and expecting a crash. It happens when there's euphoria, and that's not what we have right now. Now, if the market drops heavy, and Tom Lee is wrong about his assessment, which may very well be the case, what you going to do? Well, if the markets drops hard and everything drops seriously, what you do is you dollar cost average at a quicker pace. If right now you're buying $100 per week of Palantir stock and Tesla stock and S&P 500, then if the market drops hard, then you double down. If the markets drop, let's say 20% below the 52-week high, then you start putting in 200 a week. And you keep doing that until the market goes back up above 20%, the 52-week line. I think a lot of people need to accept this one truth, which is we exist as long-term investors in uncertainty. And people have a tough time with this. There's no way for us to have any certainty about what happens in the future. There's no way. And a lot of people chase uncertainty and kind of shoehorn uncertainty into their life by looking at a guy like Tom Lee and saying, well, Tom Lee, he can't be wrong. He's only been right, and whatever he says must happen. That's a shortcut. That's fake. That's not real. Tom Lee has been wrong plenty. I've been wrong plenty. Anybody who says anything about the future has been wrong before. So that's the wrong approach, looking at Tom Lee and saying, well, whatever he says, I'm going to do. No. Think for yourself. Use what he says as analytical tools. Don't just shortcut your way by saying, well, whatever Tom Lee says, I'm going to do. No, just listen to what he says, listen to his arguments, and formulate your own opinion and accept the fact that you might be wrong at any point, and that's fine. Anybody can be wrong. Warren Buffett can be wrong. I showed you this in the post a few days ago. Warren Buffett sold out of Delta stock and then it doubled. He sold out of TSMC. There's so many examples. I mean, I thought that 2023 is going to be a bad year for stocks. I mean, there's plenty of people who have the opposite opinion of Tom Lee. For every Tom Lee, we got to meet Kevin, who says that the world is going to end. And there's no way to know who's going to be right at the end when the dust settles. There's no way to know. The only way that I get my certainty is by minimizing my variables. So look, I know one thing. I know that I can't time the market. I don't know what happens in the future. I don't have a time machine. So how do I handle this? I listen to Tom Lee. I listen to Mick Kevin. I listen to Jeremy Siegel. I listen to all of them. But then I make up my own mind. And I basically say to myself, look, let's make business decisions here, right? Stocks is just a representation of an actual business. People tend to forget that. They think that this is some sort of paper they buy and sell. No, the stock is actually a piece of a business. So why don't we stop dealing with the stock price and look at the actual business? Why don't we start learning how to do proper business due diligence, research, and find great businesses with a lot of upside, with a lot of potential, with a lot of strength, with market dominance. Ignore the stock price completely. That's what I do. I don't even look at the stock price. I look for great businesses I want to own. I don't research stocks and price movements and none of this. I look at great businesses. So if I decide that I want to own company A and company B because they're great businesses with a lot of upside and a lot of market dominance, and I think that there's a high likelihood that in 2030 they're going to be the superpowers in this market, right? So the market can go up and down. I accept that. And the share price of these companies can swing very, very harshly as the markets do. And that's normal. So I accept that I can't make any sort of predictions about timing the market. I don't know where's the bottom and I don't know where's the top. I just don't know. So I decide one thing. Let me own these stocks. And what I'm going to do, I'm just going to follow the share price. If it goes up, I'm going to go up. And if it goes down, I'm going to go down. So what I do is I buy the share price that I have in the market in a specific week. So if one week Palantir is at 24, I'm buying a little bit of Palantir. The next week Palantir is 27, I'm buying a little bit of Palantir. And then the next week it's at 30, buying a little bit of Palantir. Then it drops to 21, buying a little bit of Palantir. Now, if I zoom out after a couple of years, what I'm going to find is I'm not going to be at the top and I'm not going to be at the bottom. I'm going to be dead center in the middle on the average, without timing the market, without taking any risks. And on top of it, there's a little bit of an extra feature that I add when I invest. And I say to myself, look, how about if on top of all I just did right now, I'll do one more thing. And when the stock price actually drops below a certain point that I'm going to decide in advance, let's say 20% below the price that was the 52-week high for the stock. In our example, if 200 was the 52-week high of the stock, if the share price drops below $160, then I'm going to say, well, you know what? Instead of buying that same amount I bought last week, this week, I'm going to double the amount. Instead of spending $100, I'm going to spend $200. And I'm going to keep doing that until the share price goes above 160. And at that point, I'm going to go back to spending $100 per week. I'm going to go back to normal dollar cost averaging. If I do that over the long haul, what's going to happen is I'm going to create a weighted average in which I bought at all times, but I bought a lot more when the share price was down. As long as I picked a good company, as long as my due diligence process, business due diligence, was on point, my share price in 3, 4, 5 years is going to be very close to the bottom without timing the market even once, without taking any risks. If I do it, because I've just created the weighted average, that's very close to the bottom. The only variable I have here, the only uncertainty left in the system is one, which is my skill set. Did I do a good job at analyzing this company? Did I do a good job at making my due diligence about this business? Because if I haven't, and this company is garbage, well, then the stock is going to go to zero. That's my assumption. But if my due diligence process was good, this system assures me that in 5 years, I'm going to have a price that's very close to the bottom of the stock without timing the market at once, without taking any risks. That's my certainty. And I can live with betting on myself. I can live with saying, you know what? If I screw up because I've made a mistake, so be it. I trust myself and I'm going to bet on my analysis skills. I'm not going to be basically subject to Mr. Market and his crazy antics, whatever they be in a certain week or a certain month or a certain year. It's as simple as that. Wait until I go back from my vacation. I'll come back around September 1st. We're going to reopen the academy because currently you can't join. It's locked. I'm going to reopen the academy on September 1st. And if you guys really want to learn the system, you really want to learn how to analyze stocks, how to do equity research, how to invest in good businesses, we can talk about it on September 1st. And if you want to try the academy, you're welcome to join. Meanwhile, if you haven't yet, I encourage you to join our Discord, discord.gg/Tom Nash. It is free to join. There's no upsell. Join us. We just had a 3 hour meeting, Zoom meeting here in Thailand yesterday. We did it. It was a blast. More than welcome to join and start honing your skill set. And that's all. Tom Lee may say one thing, Meet Kevin says another thing, this expert says this indicator says that. Stay the course. I'll see you in the next one. Peace.